Hello, everyone, and welcome back to the Financial Freedom Show. If you're new here, I like to talk about personal finance, investing, and how to make your money work for you. In today's video, we're going to dive into the iShares Core Dividend Growth ETF, commonly known as DGRO. We'll cover what DGRO is, how it works, its performance, and whether it might be a good addition to your investment portfolio. So without further ado, let's get into today's video. So first things first, what exactly is DGRO? DGRO stands for the iShares Core Dividend Growth ETF. It's an exchange-traded fund managed by BlackRock, one of the largest and most reputable investment management companies in the world. DGRO aims to track the performance of the Morningstar US Dividend Growth Index, which includes U.S. companies that have a history of consistently growing their dividends. The primary goal of DGRO is to provide investors with exposure to a diversified portfolio of companies that not only pay dividends, but also have a strong track record of increasing those dividends over time. This makes DGRO an attractive option for income-focused investors seeking both yield and growth. Now let's talk about how DGRO works. When you invest in DGRO, you're buying shares of an ETF that holds a diversified portfolio of dividend-growing stocks. This fund's holdings are selected based on their consistent dividend growth and other financial health criteria. Sectors represented in DGRO include financials, technology, healthcare, consumer discretionary, and more. This diversification helps spread risk as you're not reliant on the performance of a single company or sector. DGRO is passively managed, which means it aims to replicate the performance of the underlying index rather than trying to outperform it. This passive management strategy often results in lower fees compared to actively managed funds. Let's take a look at DGRO's performance. Historically, companies that consistently grow their dividends have been able to deliver strong returns. DGRO has benefited from this trend by providing investors with a combination of dividend income and capital appreciation. However, it's important to remember that past performance is not indicative of future results. One of the advantages of investing in DGRO is its low expense ratio. The expense ratio for DGRO is currently around 0.08%, which is very low compared to many other ETFs. This means that more of your money is working for you rather than being eaten up by fees. Additionally, DGRO's low turnover ratio can result in lower transaction costs and maximize tax efficiency. This makes it an attractive option for long-term investors looking to minimize costs. Now let's discuss the benefits of investing in DGRO. One of the main advantages is the exposure to dividend-growing stocks, which can provide a steady income stream. Companies that consistently grow their dividends tend to be financially healthy and have strong cash flows. Another benefit is the potential for capital appreciation. As these companies grow their earnings and their dividends, their stock prices can also increase, providing investors with capital gains. DGRO offers diversification across multiple sectors and companies. This helps reduce risk as you're not overly exposed to any single company or industry. Lastly, the low expense ratio and tax efficiency of DGRO make it a cost-effective choice for investors. Keeping costs low is crucial for maximizing your long-term returns. While DGRO has many benefits, it's also important to consider the potential risks. Dividend-paying stocks can be sensitive to interest rate changes. When interest rates rise, dividend stocks may become less attractive compared to fixed income investments, potentially impacting their performance. Another consideration is sector concentration. Although DGRO is diversified, it has a significant exposure to sectors like financials and technology. If these sectors experience a downturn, DGRO's performance could be affected. Lastly, the low expense ratio is a benefit. It's important to remember that all investments come with some level of cost. Be sure to consider the total cost of your investment, including any brokerage fees or taxes. So is DGRO the right investment for you? It really depends on your financial goals, risk tolerance, and investment strategy. If you're looking for exposure to dividend growing stocks and are comfortable with the associated risks, DGRO can be a great addition to your portfolio. DGRO is especially suitable for income-focused investors who want a combination of dividend income and potential capital appreciation. It's also a good fit for long-term investors looking for a low-cost, diversified way to invest in high-quality dividend-growing companies. In conclusion, iShares Core Dividend Growth ETF, or DGRO, offers a compelling way to invest in dividend-growing stocks. With its low expense ratio, diversification, and potential for both income and growth, it can be a valuable addition to many investment portfolios. Here's a few final tips. Always consider your risk tolerance and investment goals before choosing an investment. Diversify your portfolio to balance risk and return. Keep an eye on the performance of your investments and make adjustments as needed. Take advantage of the low costs and flexibility offered by ETFs like DGRO. If you found this video helpful, please be sure to give it a thumbs up and don't forget to subscribe for more personal finance and investing tips. Leave a comment down below if you have any questions or if there's a specific topic you would like me to cover in a future video. Thanks for watching, and I'll see you in the next one.